Marc Lichtenfeld is the chief income strategist of the Oxford Club. After getting a start in the trading desk at Carlin Equities, he moved over to Avalon Research Group as a senior analyst. Over the years, Marc's commentary has appeared in the Wall Street Journal, Barron's, and U.S. News and World Report, among others. Prior to joining the Oxford Club, he was a senior columnist at Jim Cramer's The Street. Today, he's a sought-after media guest who has appeared on CNBC, Fox Business, and Yahoo Finance. His book, Get Rich with Dividends, A Proven System for Double-Digit Returns, in its second edition, achieved bestseller status shortly after its release in 2012. Marc is the senior editor of the Oxford Income Letter, which is based on his proprietary 10-11-12 system. He is also the editor of Oxford Systems Trader, Lightning Trend Trader, and the Chairman's Circle Breakout Alert. Ladies and gentlemen, please welcome Marc Lichtenfeld.
Thank you, George. So today's kind of a big day for the economy. As you're probably well aware, we have the Fed meeting later this afternoon, probably right around the time that you're finishing lunch. We're expecting to get a quarter-point rate hike. So we are very likely in a period, or at the beginning periods, of rising rates. And the question that many investors want answered are, the question is, if rates are rising, are dividends done? All right, the answer is no. All right, what's happening here? Okay. So I thank you for your time. I have workshops at 2:30 and 4:30, and I will see you this afternoon. I really didn't plan anything else because I thought the weather was going to be better, so I guess I can babble for a few more minutes. Actually, I was a little concerned that you started applauding. I thought you were happy that I was done. So that's... but in all seriousness, so that is a question that people really want answered. And it makes sense that you'd be concerned about income investments, particularly dividend stocks, because if rates are rising, eventually we should be able to get some decent yields from less risky investments than stocks. I mean, I'm in the firm belief that dividend-paying stocks, and particularly ones that have been raising the dividends every year, are among the safest investments in the stock market, but obviously there's still risk there. If you can get, right now the 10-year Treasury is at about 2.5% yield. If rates continue to rise, it might not be unheard of to think that in a year, 2 years, you might be able to get 3.5%, maybe even 4% if rates really start to move. Now, if you can get 3.5%, 4% on a 10-year US Treasury, considered the safest investment in the world, would you still invest in, let's say, a stock like Qualcomm that has a 3.5% dividend yield if your primary investing goals is income and capital preservation? You know, if you're willing to take that risk, if you're looking for some upside, then yeah, you would go for the dividend stock. But if your primary goal is income and capital preservation, and you can get similar yields in US Treasuries or perhaps some other safe bonds, some really safe corporate bonds where you'll get your money back in a few years, it makes sense that there'd be a lot of concern about dividend stocks. So what I did is I went and took a look at dividend payers and specifically some segments within dividend-paying stocks that theoretically, or the belief should be, would not perform well in a rising rate environment. And the results were a little bit surprising. So first, this is just the S&P 500 return over the last 7 periods of rising rates, going back to 40 years, to 1976. And by rising rate environment, these are periods where rates went up 3 times in a row. So, you know, if there was a one-off, I didn't include that. But I wanted to have a trend where rates were on the move. And you can see that 4 out of 7 of those times, stocks in general, the S&P 500, actually did quite well. The 3 periods that it didn't, it barely went down, less than 5%. But you can see in 86 to 87, the numbers were very big. In 94 to 95, 2004 to 2006, the numbers are pretty good. So just because rates went up doesn't necessarily mean that's a bad thing for stocks. Now, how about dividend stocks? So I looked at dividend aristocrats. These are members of the S&P 500 that have raised their dividends every year for 25 years in a row or more. So very blue chip, very safe dividend payers. And this only goes back 3 interest rate periods because the dividend aristocrat index was created in 1990. So we can only go back to 1994 for rising rates. And it outperformed the S&P 500 all 3 times, and in fact actually was higher all 3 times. In 99 to 2000, barely, but you can see 94 to 95 was up 20%, 2004 to 2006 was up almost 20%. So the dividend aristocrats actually did fairly well when rates have risen. During that period, the S&P 500 average return was 9.6%. Aristocrats were up 13.4% for outperformance of 3.8%. Let's look at some other segments. Real estate investment trusts. This is an area that a lot of people are concerned about will really get hurt in a rising rate environment because as rates go up, mortgages become more expensive. Real estate investment trusts also borrow a lot of money, so their costs go up. So it would make sense that REITs would not perform well. 94 to 95, they underperformed the market, down just slightly. 99 to 2000, they did very well. And 2004 to 2006, they boomed. Of course, this was the real estate boom. So people were just buying anything to do with real estate, whether it was actual real estate investment trust, just if it had the word real estate in it, people bought it. So you can see it makes sense that it was up over 50%. I think that's a little bit of an outlier. But still, the fact that the last 3 times rates went up, REITs did fairly well. And when it didn't, it really didn't get hammered. So I thought that was a positive sign. And you can see here the numbers. S&P 500, again, was up 9.6%. REITs average return, 25%. Again, I think a big part of that is that outlier in 2004 to 2006 when we had that boom. And that outperformance was 15.4%. MLPs, Master Limited Partnerships, these are mostly energy-related companies that typically have pretty high yields, around 6 to 8%. You can see in the 2 periods since the MLP index was created, they also outperformed the S&P 500 pretty meaningfully and performed quite well. You can see 2004 to 2006, they were up over 40%, even though rates were rising. And here are just some statistics. S&P 500 up 6.7% during that period. MLPs 27% for 20% outperformance. So again, even though rates are rising, people can get decent yields or better yields than they could have going into some safer investments. They were still going into risk investments, and they weren't getting hurt at all. Business development companies, these are companies that invest in other businesses, like a Kohlberg, Kravis, Roberts. You've probably heard of that name. Big investment companies. This index only started a few years ago, so we only have one period that we can measure. It underperformed the S&P 500, but again, it was positive. So that's a very good sign. S&P 500 up 15.5%, BDCs 13.8%. So it did underperform, but it was still up double digits when interest rates went higher. Now, I think probably the one sector most people are interested in if you're a real income investor is utilities. And everybody thinks that utilities get hammered when rates rise because, again, you can get better yields or similar yields in risk-free investments or less risky investments. But also, utilities borrow a ton of money. They have huge capital needs for building out their infrastructure, improving that infrastructure, and they're just constantly borrowing money. So as rates rise, those costs go up, and their income theoretically should decline. So should the stocks. But utilities actually did okay. They outperformed the S&P 500 4 out of 7 times, and you can see that it was only down in one of these periods, in 86 to 87. In 2004 to 2006, also, they performed very, very well. The average return of the S&P 500 during these periods of rising rates was 10.8%. Utilities averaged 17.6% over 7 periods of rising rates over the last 40 years, outperforming the S&P 500 by 6.8%. So what this told me is it's certainly not a guarantee that these stocks will go higher if rates rise, but it's not a guarantee that they won't, or it's not a guarantee that they will fall. And I think that's what so many investors are concerned about, especially when it comes to utilities. There really is this very strong belief that you stay away from utilities during rising rates. And I'll be honest, I was one of those people until I saw the data. So I'm going to be reassessing and possibly looking for some utilities to add to the Oxford Income Letter going forward. I certainly want to find companies that have lower debt yield, lower debt levels than most. But the idea that these utilities don't have to get crushed every time rates rise was very reassuring, and reassuring to me as a dividend investor and as someone who writes an income letter for you guys. So I'm really very pleased about this, that we kind of don't have to go cowering in the corner just because rates are going to rise. Over the long term and even in the short term, we should be okay. There's just no evidence that these stocks get hammered. So let me tell you a little bit about kind of my process and what I look for in general, but also even why it's more important now that rates are rising. Because I think as a researcher or as an analyst looking for stocks, I think we have to be a little bit more careful, a little bit more analytical, and just pay a little bit more closer attention to the details. I think the easy money has been made in a lot of cases, that low-hanging fruit. We're 8 years into a bull market. So I think, it's so cliche to say it, but it's going to be a stock picker's market. I really think that's true. I think we have to be careful about the kinds of stocks that we're picking. So if I could only look at one variable or one measure, one metric in a stock, and I'd have to pick stocks based on this one thing. Anybody have a guess what that would be? What was that? Cash flow. I see you've been reading the Oxford Income Letter. Yes, cash flow. Cash flow is, in my opinion, especially for dividend stocks, the most important thing you can possibly look for, and I'll show you why. So this is an example of an income statement, very simple income statement. You bring in $20 million in revenue, you have $10 million in expenses, and you have $10 million in net income, right? 20 million minus 10 million equals 10. Very, very simple. Cash flow statement, and let me back up for a second here. When I was studying for my licensing exams to be an analyst, a sell-side analyst, I knew how to read the financial statements. I knew the income statements, the balance sheets, and statements of cash flow. But as I really had to kind of dig into these statements to prepare for this exam, the cash flow statement, I remember very clearly sitting at my desk, and I had this big manual open, which I actually still have today, and I still refer to it. And I'm going through the statement of cash flows, and all of a sudden it was like the angels started singing, and I just had this aha moment. Like, I get it. Like, it just all became so clear to me. And it sounds really kind of nerdy, getting so excited about a statement of cash flows. But it really just kind of opened my eyes to how important this financial statement is to understanding a company. So again, here's the income statement. Now let me show you the cash flow statement. So you start with net income on a statement of cash flows. So remember, we made $10 million, net income, also called profits, also called earnings. So we made $10 million, and you start with that on the statement of cash flows. And then you start adding and subtracting all these different things. And here's why. And this is not an exact analogy, but earnings is like if you have a job and you have a salary, right? And your salary, let's say, is $75,000, right? That would be your net income. If cash flow is the money that you actually take home after you've paid Medicare and your 401k and your taxes and all those things, that's the number you care about, right? If your spouse, your family doesn't care what your salary is, they care how much money you've brought home that you can spend on living expenses and luxuries. That's what's important. So for me, it's the same thing. Net income is the big number that's kind of broadcast to everyone. Cash flow actually represents cash that came in the door or out the door if you are cash flow negative. That's what's important, and that's what pays dividends. You pay dividends with cash, not with earnings. And here's why. So net income, we have $10 million. Depreciation and amortization. Depreciation is a non-cash expense, right? If you bought some capital equipment 3 years ago, you can depreciate that as an expense every year for a number of years. So to go back to the income statement, so in that $10 million number is, let's say, depreciation. Let's say $1 million in depreciation. That's non-cash. The company did not pay that money out this year. It's an accounting trick, basically. It's fully legal, but it's an accounting trick. So they get to lower their net income and then lower their taxes on this expense that they did not incur in that year. So for cash flow, to understand how much cash came in the door, we have to put that back into the cash flow statement. So we add that back. Does everybody understand that? It's an important concept that we didn't actually pay this money this year. So to figure out how much cash came in the door, we have to add it back into our net income. And then there are things like accounts receivable. When you make a sale in many, many industries, when you make a sale, that gets booked as revenue, and then, like we showed on the income statement, it trickles down to the bottom line, and it becomes earnings. If you didn't get paid on that money yet, then you didn't bring in the cash, but it still shows up as earnings, still shows up as revenue and earnings. So let's say you have a company and you made a sale on December 20th and the credit terms are 30 days. Well, you didn't get paid during the year, but your income statement will show revenue because you booked the sale, the expenses that may have been incurred with it, and it goes down to earnings, to your net income. But since you didn't get paid, you have to take that out of your cash flow statement. So in this situation, if we said, well, we didn't get paid on $5 million yet, we subtract that and our cash flow from operations is $6 million. So our profit was 10, but our cash flow was 6. So if you have paid out $7 million in dividends, can you afford to pay the dividend? No, you can't, because you've only brought in $6 million. Now your earnings were $10 million. And if you look at the payout ratio, and the payout ratio is the dividends paid divided by earnings or cash flow. Usually, if you look up on Yahoo Finance, on Morningstar, on any of the financial sites, it almost always will use the earnings number. Because earnings is what everybody talks about. When companies release their quarterly results, it's earnings. Did they beat the analyst consensus earnings per share number? That's what everybody focuses on. Cash flow, you have to dig a little bit more. And sometimes when companies issue their quarterly results, they don't even have the statement of cash flows in the press release. They'll wait until they issue the SEC document, the 10K or the 10Q. And sometimes that's 30 days later, 45 days later. So sometimes you won't even be in the press release. So because of that, because earnings is the big headline number, that's what everybody focuses on, payout ratios are usually quoted in a percentage, but based on earnings. But I don't care about the earnings, because the earnings represent all these non-cash factors. So I'm looking at cash flow. So in this example, you'd go onto Yahoo Finance and see, oh, well, they paid out $7 million in dividends, they earned $10 million, their payout ratio is 70%, no problem, they can afford their dividend. I would look at the cash flow statement and say, well, they only brought in $6 million, so their payout ratio is 116%. That means they're paying out more money than they're bringing in. They can't afford to pay this dividend. I've got to be careful here. And another thing to understand about the cash flow statement, why it's so important, it's also one of usually the early indicators that there's fraud or that there's something going on with your company. Because if you think about it, going back to that idea with accounts receivables, a company can bring in a sale and they can, let's say management knows that it's not going to make its quarter, and the stock's going to get punished if they miss the analyst estimates. Stock's going to get hit, and very often CEOs and other managers get bonused based on stock performance, or sometimes on earnings performance. So what do? It's December 20th. You know that you're not going to make your quarter, so you call up your wholesaler and you say, listen, I need you to take $20 million of product right now. And and you mark it down as a sale, and they can say, listen, we'll buy it back from you in 2 months if we have to, if you can't move it, but we need you to take this product. They ship it out the door to the wholesaler. They put it down as a $20 million sale, right? And it goes down and trickles down to the earnings, and they get all the benefit of that. They make their number. Stock goes up. The managers get their bonus. Everything is wonderful. That's called stuffing the channel. And because if you looked at the cash flow statement, you would see that the cash flow statement did not go in the same trajectory. So if you're looking at a company and you see that earnings are consistently going higher, but cash flow is consistently going lower, I'm not saying there's definitely fraud there, but it should make your spidey senses tingle, right? Your BS detector should be going off. Now, I don't want everybody freaking out if they look at 1 year's results and they see that, because that can happen. But if you see a trend over 3 years, 4 years, that a company is just always killing it on their sales and their earnings, but cash flow never seems to budge, you might want to start asking some questions, because that's a very easy way that management can fudge the books, basically. So let's look at a different example here. With revenue, $20 million, expenses $15 million, net income is $5 million. Now in this case, so again, we take the net income, it's the first line in the cash flow statement. Depreciation and amortization is $2 million, so we add that back in, again, non-cash expense. And now this time, accounts receivable, we got paid on what we've been owed before. So these accounts receivables might not have been from the revenue from this year. Maybe it was from last year. It was from that sale from last December 20th. But because that cash came in the door, we have to count it. So that gets added back into cash flow. So in this case, cash flow from operations is $10 million. So net income was only 5, cash flow is 10, dividends paid is 7. You go to Yahoo Finance and you look at the payout ratio, it's going to tell you the payout ratio is 140%, right? 7 divided by 5. But in actuality, they brought in $10 million of cash flow, so they are easily able to pay that dividend. And I get questions all the time, probably once or twice a week, from subscribers who, after I've made a recommendation, will go to Yahoo Finance and they'll say, I don't understand how this dividend can be considered safe. Their payout ratio is over 100%. And this is the reason why. Because their cash flow is sufficient to pay the dividend, not their earnings. And it's not unusual that cash flow will actually be higher than their earnings. And there's nothing wrong with that, because again, there's all these non-cash things that go into expenses. Stock-based compensation is an expense that companies use to lower their net income, and again, lower their taxes, but that has no bearing on cash flow. So it's why I'm so passionate about cash flow. It's such an important metric. Like I said, you can get a sense if a management team is stuffing the channel. You can get a sense on different types of things that they're doing. Another way of kind of looking at it, going back to the accounts receivables, we talked about, all right, they stuff the channel. So they make the sale, they get the account receivable on the books. One of the things that they also can do is put off a sale. So management can take let's say they know they're going to make their quarter, right? It's December 20th. They know they've hit their quarter this year. And the analysts and investors are going to be happy. So December 20th, they have a big contract coming in. They go, you know what? Let's just push this off till the following year. We'll get the paperwork signed on January 2nd. And then that way, we'll start off the quarter really well. We'll start that off strong. So management can really play with sales. They can play with expenses. But it all comes back to the cash flow. You'll see it show up in the cash flow either in accounts receivables or accounts payables. There's all kinds of things that can be done. But cash flow, unless there's, real fraud where they're making up numbers. But if the cash flow statement is accurate, it will show the amount of cash coming in the door. That's really important. So the things I look for, as I mentioned, cash flow. Coming into this year, especially with the rising rate environment, I'm looking for a history of raising dividends. That's something I always look for. A management team that raises their dividend every year has set the bar very high. They know that investors are expecting that, and it's one of the reasons that they're investing in that company. like a dividend aristocrat. They've raised their dividend 25 years in a row. If they don't raise the dividend one year, investors are going to be screaming. Management's probably going to have to get their resumes together, right? There's a reason. You've established this track record. Investors expect it. You better keep raising the dividend. And I want a low payout ratio. I want to know that if times get tough, if interest rates go up and your interest expense goes up and other expenses go up, or you have a bad quarter or a bad year, I want to know that that dividend can still be paid. So I look for payout ratios, generally 75% or lower on cash flow. MLPs, BDCs, REITs are a little bit different because they generally pay out all their cash flow or almost all of it in dividends. But for a general, a regular company, I want 75% or less. And so let me just give you an example of a stock that's in the Oxford Income Letter, and this is just a perfect example of a kind of company I like, Meredith Corp. They are publishers of magazines, mostly aimed at women, things like Rachel Ray, Family Circle, things like that. And first of all, you think, well, why? That's a dead industry. Why would anybody invest in that? Analysts hate the stock, which is something I love. If you've read my Oxford Income Letter or any of my trading services, you know that I love it when analysts hate my stock because analysts are usually wrong. And I was an analyst, so I can say that. Analysts are usually wrong. They're followers. They're not leaders. They don't stick their necks out and make bold calls generally. Perfect example, last week, maybe it was this week, it was Monday, I think, Jabil Circuit, a company that I have in the Oxford Systems Trader. Stock was trading at $26.45. An analyst raised his price target from $24 to $27. So that was really helpful. The stock was already 55 cents away from the target, $2.50 above his previous target, and he raised his target. So if you were a client of that analyst, that's not all that helpful. And in fact, you might be quite angry if you sold at 24 based on his price target. That being said, most institutional investors don't listen to the analysts, but retail investors do, and they can still move the stocks. But so Meredith Corp, nobody likes it, so I like it. $96 million in earnings, but $268 million in cash flow. So maybe their earnings aren't the most impressive thing in the world, but they've got a lot of cash flow. They've raised their dividend 24 years in a row and $90 million paid in dividends. So you look at that payout ratio, you went to Yahoo Finance, you would see 94% payout ratio based on earnings. You might think, well, that's not a very safe dividend. But when you understand the cash flow, you see it's 36% based on cash flow. They've got plenty of cash to pay the dividend, to continue raising it. They've done 24 years in a row. I'm sure they want to get into 25 years and become a member of that esteemed Dividend Aristocrat Index. That's a very big deal when companies can announce that they're part of the aristocrats or any other index of raisers of 25 years in a row. So I'm sure they're going to be raising the dividend. And it's a great little company. So that's what I'm looking for in these rising rate environments. I'm going to be looking for companies with great cash flow, low payout ratios, low debt levels too, or lower debt levels at least than their peers. And for rising rates, I don't think you have anything to be worried about. Again, no guarantee that stocks are going to go up, but it's certainly not a guarantee that they're going down. So I do have workshops at 2:30 and 4:30, and so that'll be on biotech, a totally different sector, different end of the risk spectrum. But I hope to see you then, and enjoy the rest of the day.